Amazingly enough, I got my chair back this morning. Yeah, the only person I told that to was you and Rick.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Tuesday as we get this week underway. Lots of earnings starting to come in this week. As we talked a little bit about yesterday on the show, we've got more earnings today, mostly banks today, but United Healthcare as well this morning. So we're going to start getting some of the other companies in. Thursday is Netflix as an example. So this week we're going to start to see a smattering of earnings from other than banks, right? But a lot of regional banks right now. The large cap banks, Goldman Sachs yesterday, BlackRock yesterday. A lot of regional banks. So if you're kind of concerned about kind of the regional bank situation, of course, going back to Silicon Valley Bank, a lot of people are expecting more bank failures. Well, this is the time for that information to come out, right? So if you're concerned about regional banks and what's going on, this is the time. So these earnings are going to be coming out over the next really couple of days. A lot of these regional banks report. And then going into next week, we'll start really getting into the meat of the S&P 500. So over the next 2 weeks, we'll go through and get Apple, Microsoft, Google, all these guys. And by the end of 2 weeks from now, so next week and the week after, we'll have been through about 80%-ish, give or take, of the S&P 500. So we're going to know a lot about the earnings season right now. Of course, as we've talked about before, we've drastically lowered earnings estimates up to this point. So not surprising that we're going to see a lot of beats. We'll probably see a 75% beat rate for the S&P 500 over the course of the next few weeks. That should give some support to the markets. Now, right now we're kind of in that blackout window for stock buybacks. So that support for markets has been somewhat pulled back here. But we should get some support from the earnings data as it comes in. So again, if we have a lot of companies beating earnings, that should give some support to the asset market. Outside of that, of course, the RNC, the Republican National Convention, is starting in Milwaukee. So we're going to see, get a lot of headline data coming out. Of course, it's expected, it's almost a lock that Donald Trump will be the Republican nominee at this point, particularly after the recent events. But the market is starting to try to look at what does that mean for stocks in particular areas. And over the last couple of days in particular, we've seen small cap and mid cap stocks outperforming. And in today's Before the Bell commentary, we're going to talk a little bit about that in particular. But part of that analysis is this the kind of the confluence of the data of lowering interest rates, which should help small caps. And there's a lot of risk there in that assessment, and we'll talk about that as well. But it's also the belief that we're going to start to see tariffs being put into place, infrastructure being more supportive. So a lot of the stocks that are kind of related to those areas are getting the big boost. Companies with big international sales kind of being under pressure a bit. And so we're starting to see a bit of a rotation. Now the question becomes, is it sustainable? Or is this just another kind of rotation that we've seen in the markets before? And again, what we've seen before has been this function of this kind of rapid rotation in the markets that lasts a week or two. And then it's right back to the big mega caps. And it's back to artificial intelligence. So we've seen this before. And the question, of course, is now whether that's going to be the case. But we're going to talk about that some more in a second. Look at some history. Outside of that, though, economic data, retail sales today. The Bank of America credit card spending data suggests that retail sales is going to be fairly weak. Well, now that data usually is very accurate, but lately has not been kind of right on the money like it usually is. But the Bank of America credit card spending data, they're looking at the real-time spending on credit cards. That's suggesting weakening in the consumer. So we'll see if that's reflected into the government data today on retail sales. Again, one of the things that we've been seeing over the last couple of months in particular is not only data coming in a little bit weaker than expected, but prior revisions to the data are negative as well. So the economy is definitely showing signs of slowing down. And this was kind of the focus of Jerome Powell yesterday in some commentary he made. He says, we're not going to wait until we get to 2% to cut rates, because if you wait that long, the economy's under too much pressure already. So to go from 3% inflation to 2% inflation, you're going to need a pretty sharp slowdown in the economy, and the Fed wants to get ahead of that. So again, this is why expectations, and we'll talk about this with John in a few minutes, but this is why expectations for Fed rate cuts is now pushing 90% for September. So again, and markets are now back to 3 rate cuts for this year. So again, didn't take much. We're back to a lot of optimism on rate cuts. Okay, let's talk about what you need to know before the bell this morning. Yes, small and mid caps have been the news over the last couple of days in particular, as they've outperformed large cap stocks by a very large degree. And you can see this in this chart right here. Nice buy signal on mid caps, extremely overbought right now. We are now 3 standard deviations above the 50-day moving average. Again, that is a very, very extended move in a very short period of time. We've seen these moves before previously, and there's a couple of things to really kind of note about this. But again, generally when you get above 3 standard deviations, good time to take profits. So if you've had some small cap exposure, this is probably a good time. These type of extended moves generally don't last for very long. In particular, if we take a look back at small and mid caps over the course of the last 3 years, it's a very, very different story. When you take a look at large caps, of course, we've been talking about how large cap stocks, the S&P 500, the NASDAQ, making new record highs virtually every day here recently, really have been making new highs for the last year or so. As it broke out above that January 2020 high, mid caps, small caps have not done that yet. Taking a look at the Russell 2000, yes, we had a very sharp move here, but this is pretty much still within this realm of this trading range that mid caps have been in now for really the last year and a half. Here's your previous high in January of 2021. So again, you haven't really done a whole lot, but we are back on a buy signal, as I said. But we're starting to get to more overbought conditions. So now the question is this the rotation? Is this the time now that small and mid caps are going to take the lead from large cap stocks? That's the hope right now for a lot of investors, and they're going, hey, this is the rotation. But we've seen these moves before, and they fail every single time. There's a couple of reasons to be concerned about this particular move, and I'm not saying that this isn't the moment, right? That this finally breaks out and plays catch up, but there's a couple of problems with the small cap, mid cap space. 40% of these companies are now basically non-profitable. They don't earn money, and they're very dependent on debt. So the problem is going to come up for a lot of these small and mid cap companies over the course of the next years. They have to refinance that debt. They may or may not be able to do that depending on what's happening with Fed policy, what's happening with interest rates. Is the yield come down enough to really support that? The second problem for small and mid cap stocks is they are very, very dependent on economic activity. They are more sensitive to changes in economic activity than large cap stocks in general. So again, if the economy is indeed slowing down, you're going to see more of an impairment to earnings in the small and mid cap space in particular. Lastly, to be concerned about is that small and mid cap stocks do not have the capacity to do very large share buyback programs like large caps do. So that support that you have seen inside of the large cap stocks that have kept stocks higher is not available because they can't do the buybacks. And more importantly, they don't benefit as much from the passive flows of ETF investing. So again, what we've seen is 35 cents of every dollar goes into those large mega cap stocks. That's not the case with small and mid cap. So look, nice rally here, take advantage of it. But again, let the market tell us what this is going to eventually turn into rather than banking on it for right now. Lots of problems in that space. Okay, that's what you need to know before the bell this morning. When we come back, we'll pick up with John Penn. We're going to talk about the markets, and with Fed rate cuts coming up, what's a better investment, stocks or bonds? Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So good morning and welcome back to the show this morning. Got a few things to get into. John Penn joining me this morning as always on Tuesday. How are you? Power back?
Power's back.
Nice.
Getting back to a sense of normalcy.
My wife's aunt, who lives over by Piney Point, if you live in Houston or where that is, she's still without power.
Yeah, there are still folks without power. Hey, our portable generator worth every penny.
Yeah,
every penny. So.
Oh yeah, absolutely. I will be putting. I had a very interesting. I put it out on Twitter that I was going to be buying a new generator for the house we're remodeling after all this, and it's like, well, why don't you get a Tesla Powerwall? And it's like, I go, because they suck. First of all, they're very expensive.
There's an answer.
Well, first of all, they're very expensive to install. Solar panels are not cheap by any stretch of the imagination. I explored that whole avenue at one time. And of course, when you spend days where it's really cold or really not sunny, right, you run into problems. The thing about a natural gas generator, when it's directly connected to your house, it is nonstop power.
Yeah, I mean, that's what we did. Our natural gas line, I can provide natural gas straight to the generator and just run that thing.
Yeah.
And so compared to most,
and it's cheap.
And it's inexpensive.
Yep.
And compared to most, I feel very fortunate. It's not perfect. It's not a whole home system, but it provides everything that we need.
Oh, absolutely. Mm-hmm. No, and this is so I'm going to be installing a whole home system.
Yeah.
So I priced this out before. It's about 1/5 of the cost of doing a solar powered solution, and the ongoing maintenance is very cheap. The ongoing and the actual usage of it as natural gas is cheap anyway. So. And it's just unstoppable power. It doesn't matter whether it's raining or snowing or we're in the middle of a blackout. It's going to work.
Absolutely.
So, yeah.
Yep.
But yeah, so definitely be doing this here soon. So let's talk about something everybody's got on their mind right now, which are rate cuts. I wrote an article today. It's on the website at realinvestmentadvice.com talking about stocks versus bonds and what's a better option when the Fed's cutting rates. And right now, following the most recent CPI report and some of the latest economic data, unemployment in particular is starting to become worrisome for the Fed. There is now a 90% expectation of a rate cut. And Brent's going to bring this chart up just any second. I just know he is. He's He's got what?
Waiting for my cue, as you can see on this chart.
There's a lot of love in here this morning, folks, if you can't tell.
And I just bought you a present from Greece, too. You need to be nice to me.
And it's excellent.
Anyway, you can see there's a 90% chance of a rate cut coming in September. And that is, has just surged here recently because of some of this economic data. Now, the expectation from the market is that, at least this is the way the market's behaving right now, is that when the Fed cuts rates, then stocks are going to go up, right? Because we've got this easing of monetary policy. And so as the Fed cuts rates, that means that it's easier monetary policy. And you can understand, this being the case because over the last, couple of years, this is what the market's been doing. Every time the Fed was, or anytime data came out, the market would assume it's like, oh, the Fed's going to cut rates here. And the market would rally, and then the Fed would come out and say no and disappoint the market. And then the market stocks would sell off. And then we'd rally again on expectations of Fed rate cuts, even though the Fed was still hiking rates. And this has just been a repeated event in the markets, ever since 2021. And we've gone through that bear market or that correction, rather, wasn't a bear market, but a correction. And these rallies have all been based upon this idea that we're going to get these Fed rate cuts. And that just hasn't come to fruition yet. And here we are once again rallying on the expectation of Fed rate cuts. But again, that's not the case. Now you really can't blame the markets for this because, as you can see in this chart, for Brent's Q, this has been trained for investors ever since 2009. The Fed cut rates and did QE and $43 trillion worth of monetary interventions. And the only times the markets really kind of hiccuped was during either when quantitative easing stopped momentarily before they started the next program, or when the Fed hiked rates initially in 2015, stocks sold off slightly during the EU crisis, the whole Brexit thing back then. And then we had the Fed taper tantrum, the stocks sold off. Then you had COVID, Fed cut rates, stocks rallied. But you'll notice that when the Fed cut rates, that was where markets didn't do well. Why were they cutting rates? Right? This is the whole issue. And so we've now been hiking rates and we're getting set up again for these Fed rate cuts. But, historically speaking, and this is kind of really the important point, is that going back to 1970, there is a very high event status of Fed cutting rates and stock prices falling. And this is because stock prices fall as the Fed cuts rates because the Fed is responding to some type of financial event, an economic turn, whatever it is, that's impacting and impairing earnings. And so when you have this valuation realignment, stock prices are falling. And again, this shouldn't be a surprise, but again, it's been so long now since really 2009 that this is now becoming an issue. Now, as I said, the important thing here is that when the Fed's cutting rates, it is in response to an economic event that is impairing earnings. And so, and this what this chart shows you is going back to this goes back to 1995, but you can go all the way back throughout history. But whenever the Fed is cutting rates, earnings are falling. And earnings are falling because economic growth is slowing down, consumers are spending less, whatever it is. But whenever the Fed is cutting rates, you're going through this. Now, the expectation currently is for the markets is that earnings are going to keep going up even though the Fed's cutting rates. That just hasn't been the case before because, again, why is the Fed talking about cutting rates now? They're saying, hey, employment's rising. It's above 4%. It's going up. Some technical analysis on employment suggests it's going to keep going up this year. The economy is slowing down. We're seeing that in the data. That doesn't bode well for increased earnings per share for S&P 500 companies. And so again, this is why that's the case. But in the event that the Fed is cutting rates, a couple of things are going to happen. And if the Fed is cutting rates because it is in response to slowing economic activity, potentially the onset of a recession, some type of financial crisis, whatever it's been historically, the go-to factor has been Treasury bonds. It's a safe haven. So money flows from the stock market into Treasury bonds as that safe haven. Now, we're talking about specifically Treasury bonds. We're not talking about corporate bonds or high yield bonds or anything else, because those are subject to default risk in a slowing economy. So yields on corporates, high yield, et cetera, tend to go up as yields are falling on Treasury bonds. Again, it's that safe haven movement. So bonds tend to do very well during a rate cutting environment. And in fact, if we just go back and look at the 10-year Treasury versus the Fed funds rate, there's a very high correlation between cuts in the Fed funds and falling 10-year Treasury yields. So as the Fed starts cutting rates, yields are going to fall because of two things. One, the Fed controls the short end of the curve. That's all they control. So everything from the 3-month T-bill to the 2-year Treasury bill, that's in response to what the Fed is doing. So as they cut rates, those yields will fall. The long end of the curve is structured by economics. And so on the long end of the curve, as the economy weakens, because the Fed is cutting rates and those yields are coming down, the long end of the curve falls as well. So again, 10-year Treasury, 20-year Treasury, 30-year Treasury, those will all decline in yield as the Fed begins cutting rates. And again, this is just a function of the response of yields to the macroeconomic environment. And so if you're kind of interested in what does that suggest, if we go back and look at where the Fed was hiking rates, and that was where, as the Fed hiked rates, yields fell or yields rose on 10-year Treasury bonds, the prices of bonds fell by about 50%. So from this point, if the Fed goes back to cutting rates, there is the potential for about a 70% rate of return on Treasury bonds going forward as the Fed cuts rates. And the more aggressive they get on those rate cuts, and if the economic data does weaken towards recession, the upside potential for Treasury bonds from this level is actually fairly good. So again, it's just, but again, not for stocks, because again, stocks are going to have to reevaluate for declining earnings and slower earnings growth. And again, the valuation premium right now is around 35 times earnings. That's very expensive. So again, that valuation reversion could be fairly significant, 20, 30% downside in stocks and 30 to 50 to 70% upside in bonds, depending on how far rates ultimately wind up going down. So anyway, that whole article is on the website this morning at realinvestmentadvice.com. If you want to look at all the charts and read the whole thing, it's there for you. But John, any comments about this? Because the reason I bring this up is because it also feeds into one of your questions about clients sitting in cash right now.
Yeah, I mean, and there's kind of, in conversations that I've been having as of late, it seems like there's two camps out there right now, kind of two major camps. One, it's investors that maybe haven't invested yet. They are sitting in cash. And now what? How do we tip our toe in the water? Does it make sense? Or folks that have been invested, hey, it's been a great year so far. Well, do I start taking some risk off the table? It's like, is there some give or take here? So it's like two camps right now, right?
Well, there's those two camps, and then there's also the guys that are sitting at 5% money market going, hey, I'm just making 5%. Yeah. I'm fine right here. And that's got a lot of risk to it.
It does.
So we'll come back and talk about all that with John Penn. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Today is a very sad day because we had a very serious set of deaths in our house.
The Real Investment Show podcast.
It's been just a very traumatic few days. We lost our new coffee maker, we lost our air fryer, and we lost our oven when this power surge came through the house.
Same show, your schedule.
That's how big the surge was coming through the house, but I've not had coffee for 2 days, so just beware. I don't know what you're going to get this morning on the show, but
at realinvestmentadvice.com.
I'm a little cranky.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. So just reading through some of the chat comments, that's interesting. You guys.
Hey, look, we got the Fed chairman this morning.
I know.
How about that?
Yeah, you know, create any handle you want.
That's it.
Have fun with it. That's all the important things. Anyway, so a couple things here talking about, you know, we've had a lot of clients lately, a lot of prospects lately that are talking about, hey, you know, I'm in 5% money markets right now. I'm fine right where I'm at. Mm-hmm. Huge problem with that is that, yeah, you're fine. So there's a couple of things that investors repeatedly make mistakes on. And one of that is assuming that a rate will remain the same for a period of time. And the second is that they forget to account for inflation. And, you know, so one of the things I've run into a lot lately, John, is I've got, you know, back in 2022-ish, I guess, somewhere around there was this whole push for, I just want a portfolio full of bonds. And I'm just going to buy, all my money and put all my money into 5% yielding Treasury bonds. Great. Awesome. And that's okay, right? If you're good with 5%, there's nothing wrong with that. The problem, though, is that 5% does not adjust for inflation. Yes, you'll get 5% this year. You'll get 5% next year. You'll get 5% the year after that. Absolutely true. Until the bonds mature. But the problem is that 5% doesn't adjust for inflation each year. So your 5% is becoming 4.8%, 4.6% as inflation continues to go up over time. And it will, because inflation will always go up. That's just how inflation works. It's always going to be going up. And again, the goal is for inflation to rise at 2% a year or 2.5%, whatever the Fed eventually settles on. But inflation is going to be going up. So every year that 5% is eroded by the purchasing power parity caused by inflation. So this is why it's very important that in your portfolio that you have, and there's nothing, again, absolutely nothing wrong with treasuries. As we said, they're a safe haven play. And ultimately, when things get bad in the markets, that's where money's going to go. And that's going to drive yields low very quickly. And the price of the bonds will go up. And it's a great hedge for the stock side of your portfolio. Gold is going to, and if you want to own gold, that's certainly okay. But that's a risk asset as well. Right? Bonds are a safe harbor asset. So, but what gold and what stocks will provide you is if they go up in price over time, and that's the goal is, right? I want these assets to go up in price. If they go up in price, they act as the inflation hedge. So the 5% that you're getting from your fixed income portfolio is being offset by the inflation adjustment caused by the rise in price in the stocks and the gold, et cetera, right? So that's why you have to have a balance of assets in your portfolio. And then you start asking yourself, well, what asset do I want to own and how much do I want to own? And that's all personal that you've got to work yourself through. And again, that we get into these narratives like now, everybody's like, oh, gold's hitting a new high. That's great. It's vastly underperformed the markets over the last 50 years. So, when you talk about an inflation hedge, your best inflation hedge, hands down, without exception, is stocks over the long term. So again, nothing wrong with owning gold, right? It's part of it's the narrative that's going on right now. It's doing fine. It's having a good year, and it's a commodity, so it's going up in price. So enjoy it, right? Nothing wrong with it. It's part of your asset allocation, but don't ignore the inflation process over time, because that's the most important thing, John.
Yeah, well, I mean, a lot of the individuals and families that I visit with on a regular basis, most of them, I'll not say all, but well over a majority of them have some allocation in their overall portfolio to some precious metals, gold or silver. Mm-hmm. But they're not really trading it. Mm-hmm. They just kind of own it as part of their overall asset mix. Mm-hmm. And no matter what the price of gold or what the price of silver does as it ebbs and flows, they just maintain it. They just hold it. It's a diversifier. They don't approach it in the way of Armageddon's coming. I'm going to have to go down to Kroger to buy a loaf of bread with gold coins. That's not the mentality around it. Mm-hmm. It's just a diversifier. It's just part of their overall investment mix, right? And it's healthy. It's all about
nothing wrong with that.
And it's balanced, right? So many points that you brought up there about folks that are still folks that I visit with on a regular basis since the great financial crisis, or even as of most late, mm-hmm. Q1 of 2020, when economy was going into shutdown mode and everything was selling off, right? And they went to cash, and they've been waiting to get back in. And now, to your point, the underlying theme, what they are concerned about, is inflation, and how inflation will erode their future purchasing power. So they know that they need some equity exposure, or they want some equity exposure in the portfolio. But now they're hearing all the rumblings of, well, the Fed may be cutting rates this year. That may not be so good for equities, because why is the Fed cutting rates? So then there's always that reason that they can make in their mind of, well, Lance, I'm not going to buy stocks right now. I'm still going to wait. Right. I'm still going to wait. And then so it gets prolonged more and more and more. So, in the previous segments, you were talking a little bit about, hey, this might be a better time for treasuries, kind of that flight to safety. Maybe it isn't a healthy time for stocks, but you're not saying get out of stocks.
Right?
No. So maybe talk a little bit more around, okay, if somebody, let's say you are not in equities yet, is there a way where maybe you can, does it still make sense to kind of dip your toe into the water and start building in some equity exposure? How would you approach that?
Well, this is always a challenging part, right? Because we get a new client in, and they're like, okay, here, we want you to manage your money. And the hard part is always getting in. Right. And we get a lot of accounts that come over, they're all in cash, and they're like, okay, fine, I give up. I need to get in the markets. And so the hardest part of the investment process is the initial allocation, right? And because you may be buying the top of the market, you just don't know. And so what you have to do is step in slowly. So you take a third of your portfolio and buy 1/3 of the stocks that you want to own. And then eventually you'll get a dip, right? The market will pull back. We'll have a correction like we had in April, or one like we had last year. You had that 10% correction. And then you take and you add some more. And so you just kind of dollar cost average in over a period of time, maybe. And this is why we tell clients regularly that, when you first come over here, it's great, but don't expect your portfolio to get built for 12 to 18 months, because we just take our time in trying to get that money allocated towards the equities that we want to own. And so that's the most challenging part. It requires a bit of patience and discipline. But then once you're allocated, it becomes much easier, because then it's just a function of risk management, right? Yeah. Trim a little here, add a little here, and that works better.
Yeah, I think sometimes there's a fear that, hey, if I engage with a financial advisor, whatever that allocation decision is made for me, that at a flip of a switch, money just gets dumped in the market.
Right.
And by all means,
well, that's the way a lot of firms work.
That is the way a lot of firms work. And there's and every firm has a different approach to this. Not knocking other firms. Every approach has a different approach to this. Every firm has a different approach to this. And so as you're out there kind of maybe trying to find a firm that's a good fit, you want to make sure that there's a match in an investment approach or philosophy there. Mm-hmm. And by all means, we could easily just dump money into the market overnight, and the market could take off running, and you're going to think we're brilliant. But at the end of the day, we probably just got lucky, right?
That's right.
So it makes sense to kind of take a slower approach and nibble, get some exposure, and then that way, keep a little bit of cash back. It doesn't have to be an all or none decision. So to Lance's point, if there's some weakness or markets pull back a little bit, you can get some entry points at a better value, and it just takes time to build. But at least you can start getting your toe in the water, start to build in some of that equity exposure, whatever that percentage is that makes sense for you. All going back to that financial plan, we talk about hurdle rates a lot. What is that rate of return that you need to earn over time for your financial plan to work? And that helps us back into an investment approach that we think makes sense for you, and you start building in that equity exposure. And you just got to be patient with it, right?
That's right. And again, that's the case with everything when it comes to investing, right? Is avoiding the narratives and just being patient with the process, whatever it is. And again, whatever your process is, it's fantastic. But the important thing is to remember is that there is no permanent this is the most important lesson, right? There is no permanent asset to own, and so, stocks, they go up in price, they go down in price. Bonds, they go up in price, they go down in price. Gold goes up in price, goes down in price. These are all just assets, and they're all traded assets. And again, and we talked a little bit about this yesterday, is that these are just ethereal pieces of paper in most cases. And so your job is to invest in assets that are going up, and making sure and hedging risk along the way, and taking advantage of that, and growing your capital over time. And it doesn't matter how you approach it. And again, there's no wrong way to approach things, but you can make a lot of mistakes by making all-in bets on one thing or another. And again, this is the biggest risk that people that have bought, all their money is in bonds now, right? It sounds great. I'm getting 5%, or I'm getting 5% in a money market account. Why do anything? Because that's going to end. As soon as the Fed cuts rates, that will end. And then what are you going to do, right? So this is always why it's about balance. And as with anything in life, when it comes to investing, it's all about balance. And however you want to approach it is fine. But again, you've got to find a better balance that will help you actually hedge for inflation over time and grow your assets and manage that risk accordingly. And again, a lot of these big narratives about the end of the world and all these type of things, are just not the case. And the economy will survive, the markets will survive, stocks will go up, eventually, over time. Yeah, you're going to run into some hiccups along the way. That's why you manage risk, right? But being all in or all out or all in one asset or another typically does not work out well over the long term.
Yep.
All right, quick break. We'll come back. More stuff to get into. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So as I said today, we've got retail sales for June. That's expected to come in at plus 0.1 this morning. We also have the import index as well as export prices. That's, kind of one of the looks at kind of inputs of inflation, right? Or export prices, import prices going up or down. Those are expected to come in a little bit negative this morning. The import price index is expected to be negative 0.1, and the export price index is expected to be negative 0.6. So, I apologize for that. That is not correct. 0.1 versus 0.6 previously. So both expected to be negative 0.1 today. And the National Association of Home Builders Sentiment Index is expected to be at 43, which is where it was last month. That's come down a lot. Home builders have not been very optimistic on the home market. And in fact, part of the supply problem in houses is that new home builders don't want to build new homes because there's just not enough demand right now. And again, as Mike was talking about this last time he was on the show, is that if you take a look at the transactions in the homes, there's not a whole lot of transactions that are going on. And now houses are sitting on the markets for a lot longer. So that whole demand side of the equation is slowing down, which is going to erode sentiment for home builders even more. Again, they're supply demand driven, just like everything else in the economy. So all that's coming out this morning. Bank of America, Morgan Stanley, United Health, Charles Schwab, Interactive Brokers, Progressive, PNC Financial, and State Street all report earnings today as well. So again, mostly banks, as I said earlier today, that's coming out. So John, last segment of the show, what you want to talk about?
So had a really interesting comment lately, as of late, from a gentleman that I was talking with, and he kind of falls in that camp of, hey, I'm in this money market fund right now, earning it's about 5%, maybe a little over 5%, and why, and he was out there maybe kind of thinking about engaging with an advisor, wasn't sure, was trying to determine how much help they were looking for. And his question was, well, I'm getting 5% right now, and I'm not having to pay anybody for any help, and I'm getting 5%, and I'm feeling pretty good. And so we had to take a step back for a moment and say, okay, well, let's look at the money market that you're in, at the firm that you're in, and there is an internal cost in that money market fund. You just don't see it.
Right.
There's an internal operating expense. It's just that you don't see it. That 5%-ish that you're getting right now is a net return that company is paying out to you after they are charging for managing all those short-term debt instruments within that money market fund to get you that 5%, right? So the firm that you're with isn't doing that for free, right? Yep. You just don't see the fee. It's not a itemized fee that comes out on your statement. You just don't see it, right? Mm-hmm. So then the question was, well, he asked, well, why should I maybe pay a little bit more for help from an advisor? And you looked at what the internal operating expense was on this mutual fund, and to engage with an advisor, the incremental cost or the extra amount that you would pay wasn't much more, honestly. And then there were a lot of questions around, well, when should I take Social Security? Should I take it at this age? And then what about my spouse? And hey, I'm coming up on this magical age of 65, and I have all these questions around Medicare. And it's like, well, have you asked your money market fund about that? Probably not, right? Because they're not going to, that's the type of guidance that an advisor can provide, right? Right. So I think there's just sometimes some misconceptions out there. Hey, I'm getting this for free, and I hate to tell you, folks, nothing's for free, right? So you got to take a look at those. At what are the internal costs that you're paying, not just on your money market funds. Hey, even exchange traded funds. Granted, the internal operating expenses on exchange traded funds are a lot less, but even a lot of questions around mutual funds lately, where sometimes, folks will share their statements with me and there's a mutual fund with a capital A behind it or a capital B behind it. That is not a grading system. It's not telling you that this mutual fund is scoring an A or this one is scoring a B. That is telling you, how do you pay your commission for either buying that fund, which is called an A share or front end load, or if you don't want to pay the upfront load to buy that particular mutual fund, that representative may say, well, Lance, you don't want to pay the front end loan on the front end commission on the A share. Let's just buy the B share instead. So that way, if you hold this fund for X amount of years, you don't pay the commission going out. That's called a B share. You have to realize how all these fees come together when you're working with a financial professional, right?
No, that's right. And again, it's always comes down to, again, we talked about this, I think, a little bit before you and I, that, people don't use a financial advisor correctly.
Yeah.
They think it's just about investing money, and that is the least important part of having a financial advisor, a good one. It's all the financial planning, it's the estate planning, it's all the other, life choices that you make around Social Security, Medicare, all those things that will cost you tremendous amounts of money if you do it incorrectly. Again, you don't go to a doctor just for one purpose, right? You go to a doctor, get a checkup, they check everything, make sure you're healthy, and then they fix the problems that come along. But this is a mistake I think most people make with advisors. They think it's just about the portfolio management, and it's not. That's probably the least important aspect of the entire process of working with a financial advisor. And again, if you're not using your financial advisor properly, using them as a professional in their field, like you would use a doctor, like you would use a lawyer, like you would use anybody else, then you're not taking advantage of the money you're spending, right? And you should be talking to them, interfacing with them, working on your budget, working on your life plan, working on Social Security, Medicare choices, all those type of things. That's what you're paying for. And again, I think most people vastly underappreciate and underutilize. Again, I'm a portfolio manager. I'm not a financial advisor, so I'm just telling you, John's the financial advisor. So again, my job is probably the least important job of the entire firm, relative to what you're paying for and what services that you get.
Well, I would disagree. I mean, this is all a very collaborative effort. But just so here's a great point. So after we just had this hurricane or the storm here in Houston. So there's a lot of talks around generators and, hey, should I get a whole home system, or hey, what can I expect to pay for a generator? And we are so fortunate and blessed here that we visit with folks all across the country, from the East Coast, the West Coast, to the middle of the U.S. We work and talk with folks that live and work overseas. So it's amazing how many times in conversations as of late the topic of generators come up. You and I were just talking about it in the first segment. But there's a lady here in Houston that I work with. She's 83 years young, and she lost her husband about 2 years ago. And she called me out of the blue. She was like, "John, I've got a really strange question for you. I don't even know if it's financial related, but I want to talk to you about this." And she said, "I think I'm going to get a whole home generator. And this is the quote that was provided to me. Do you think this is fair?" Well, based on all these other conversations that I'm having with folks about whole home systems, I said, you know what? That's a fair price. You should do that.
Yeah.
You're not getting gouged. They're charging you a fair price. You need to move forward with that.
Yep.
And it's not portfolio related. It wasn't tied directly to her financial plan, maybe somewhat because we've budgeted for these extra expenses for maintaining her home, but just even a little kind of a peace of mind conversation. I mean, I think that goes a long way.
No,
right?
it's true. And again, this is as we talk about these very specific issues, this is what should be really important, right? Should I buy a house now, right? Should I buy a car now? Should I buy new or used? Should I lease?
Yeah.
A car or not. And all these have very specific recommendations based on, your current situation. You own a business. Maybe you lease through your business rather than buy a car outright. But there's all these choices that we can make that can either cost, and again, that can either cost us money or save us money by just making the wrong choice because we just don't know better. And, hopefully your financial advisor is very adept at doing this. Again, that's not my job. But, that's the choice to make. Do I take money out of my 401k now? Do I wait? Do I take Social Security at 62 versus 67? And, most of the time everybody says, oh, don't take it at 62. But there may be some reasons to take it at 62. But again, it depends on your personal situation and what's going on and what your needs are and those type of things. But that's what a good financial advisor will help you through to make the best decision.
Or just to recognize when there might be an opportunity for you to maybe do something a little bit different with your financial planning, retirement planning now that will set you up for even greater success, 5, 10, 15, 20 years from now. So example, what is, how do you earn your income? Are you W-2? Do you have some self-employment income? Do you have some 1099? Just spoke recently with a gentleman who doesn't have the ability to participate in a company 401k plan. He does receive some of his income via W-2, but he also has some really healthy self-employment income. I said, well, do you have a CPA or a tax advisor? Yes, I do. Okay. Have they spoken with you or have you asked them about, does it make sense for you to contribute to a SEP IRA or maybe a solo 401k? And just a little bit of silence on the phone. Oh, nobody's ever spoken to me about that before. I said, okay, well, tell you what. Who is your CPA? Let's have a joint conference call with them. Let's set up a joint Zoom call with them. Let's make sure we're all on the same page here because there may be some ways where you can defer or set some extra money to the side now that's going to only help you, like I said, 10, 15, 20 years from now, right? Or, hey, a lot of folks that I visit with Lance still, they've been meaning to get to their estate plan and have their wills and their durable powers of attorney, medical powers of attorney updated for the last 20 years of their life. Mm-hmm. And it's just something on their list that they, what, John, I've been meaning to get to that. What, Lance, I've been meaning to get that. I just can't get to it. Okay, let's make 2024 the year where we get this done, right?
Right.
So it's all about, I think we all get so focused on, stocks and bonds and exchange traded funds, and that's all so important, Lance. But at the same time, too, there are some broader areas of risk management from a financial planning standpoint that we can look at, too.
Yep, absolutely. That's great. All right, that wraps up the show for the day. Appreciate you hanging out with us this morning. And, of course, we'll be back tomorrow for Wednesday's edition of The Real Investment Show. Get by the website, that new article on stocks versus bonds, what's a better choice when the Fed's cutting rates. That's on the website now. And, of course, our daily market commentary is out this morning. And our daily market commentary this morning covers the small cap, mid cap space in particular. So that's all on the website. It's all free for right now. Maybe someday we charge for that. We'll see. But for now, it's free. So you might as well go get it. It's all at realinvestmentadvice.com. That's realinvestmentadvice.com. Have a great day. Be sure to like and subscribe to the channel. We certainly appreciate it. And we'll see you back here tomorrow.